Hello, everyone, and welcome to the Final Bar. It's Tuesday, June 25th. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a beautifully sunny Redmond, Washington. Thanks for joining me every weekday after the close as we break down the market action. Yesterday, bit of a mean reversion with the technology, communication, really consumer trade showing some short-term weakness, following through on the weakness we started to see Wednesday, Thursday of last week. Today, right back to where we started, those AI-fueled names like semiconductors, cruise lines, and others pushing to the upside. Alphabet making a new all-time high. So the strength that we've seen in growth stocks continues to be quite strong. With that in mind, let's look at our market recap and focus on how the charts evolved over the session here on Tuesday. You can see the S&P 500 finished today up 0.4%, and that's just below 5470. You can see the Nasdaq composite up much more, around 1.25% to 17,718. The Dow down about 0.75%. So yesterday, obviously, those percentages were flipped. We had the energy, industrial type of stocks working very well yesterday. Today, kind of right back with the the story that is really dominated off of the April lows. Growth over everything and large over small. That's your day today. Well, the Nasdaq was up 1.25%. By the way, the mid-cap and small-cap S&P indexes were both down 0.9 to 1%. The S&P 400 mid-cap index was down a full percent. The VIX moved slightly lower as well, about half a VIX point to just below 13, around 12.8. So again, VIX remains very low. That means relatively low volatility. That means low uncertainty. That means low fear. That means markets are just fine, according to the S&P Index Options market. Interest rates overall honestly did not move a ton here. 10-year yields and long bond yields, 5-year points, very similar to where we finished today on Monday. 10-year yield currently is around 4.24, so just below 4.25. The long bond yield is slightly higher, around 4.38. Of course, the short end of the curve is still elevated. So we do have that inverted yield curve, which has really been the story here for quite some time. Overall, you would think if and when, it's probably more when rather than if the Fed starts lowering rates, most likely in the fall, you start to see that yield curve more normalize. It's very much dependent on economic conditions continuing to slow that, show that inflation is coming into check and that economic conditions are slowing down to the degree that should compel the Fed to lower rates. So we do have some economic data coming later this week, GDP numbers, so certainly could be an important data point to follow. Bond prices, of course, slightly higher when yields are slightly lower, and the dollar index, really no change. A lot of red on the commodities page. You can see the gold ETF GLD was down about 0.5%, silver down 2.25%, copper prices down as well, crude oil prices. So yesterday we saw energy leading, we saw crude oil up today, sort of the reverse of that trade. Bitcoin finally getting a bid here. You saw that over the last 48 hours or so, you can see Bitcoin was above 63,000. Going through Monday's equity session, we actually dipped below 60,000 for the first time since kind of April, May, which is when we last established that support around 60K. We did look at that chart yesterday. I'll show you briefly in a bit here so you can see how, from my perspective, Bitcoin is bouncing off of support as you'd expect. This is what it should look like when something like Bitcoin hits an established level of support, hits a key Fibonacci level, hits a key, big round number like 60,000. You'd expect a bounce higher if we're coming down to that level. That's exactly what we've observed. This is why we talk about those sort of levels, right? Those key levels to pay attention to, because more often than not, the markets tend to what we call respect those levels and bounce where you'd expect. So Bitcoin currently around 62,000. That's up about 3% from yesterday. Ether price is just above 3,400. That's up about 2%. Looking at the 11 S&P sectors, you can see 3 out of the 11 finished today's session in the green. Technology up 1.8%, communication services up 1.1%, energy up 0.2%. All the other 11 S&P sectors moved lower. Real estate was at the bottom, down 1.4%, followed by materials and utilities, which are about 1% lower. Looking at the Magnificent Seven and Friends, you can see that NVIDIA, which had a rough couple days coming out of the Juneteenth holiday, Thursday, Friday, and then into Monday, a lot of pain, and it'll look like a little blip on a 2-year daily chart, but it is a big move from all-time highs down to where we were today. We recovered a lot of the losses we experienced yesterday. NVIDIA closing almost 7% higher. Nice move back higher, just above $126 a share. Alphabet, as I mentioned, making a new all-time high, closing above 184 for the first time. You can see 184.03. All of these leading growth names were up. That is why the Nasdaq 100 led everything else. That is why the S&P 500 was higher, because technology, semiconductors, were the second to the top performing sector out of all the Dow industry groups. Let's go to a daily chart of the S&P 500. We can see how today's move sort of fits into this framework we've been talking about. And overall, of course, the story has been the incredible rally off of the April lows, brief pullback in late May, but overall, this is a clear pattern of higher highs and higher lows. Now, all of this, of course, is the latest move off of that initial thrust off of the October 23 low, where the S&P was around 4,100. We peaked here in late March around 5250. Come on, Keller. And then pulled back to around 4950. So just below 5,000. And we sat there, sort of the last latter half of April before rebounding and pushing back above the 50-day moving average. From there, it's been lights out uptrend. Now, the last week has really been more consolidating than everything. After that big update, week 2 ago, we've really been just sideways, right? And today, while it was a nice update, this is after yesterday, we were really closing lower through the course of the day. So I would say, in the ultra short-term time frame, like during the day, nice upswing, nice leadership from some of the growth names that have done so well year to date in 2024. But really looking at the last week or two, it's essentially been a gap above 5,400, and now we've stalled out a little bit. You really want to see the S&P get back above 5,500. That would sort of continue a very clear uptrend. And now I would say it's clear and it's certainly an uptrend, but not as clear, right? It's a little murky, little cloudy uptrend. The S&P's RSI, a measure of momentum, is still technically below 70, but it's very, very close to getting back to that overbought region. And we mentioned that looking back to sort of November, December, January, February, you can see how much that the RSI, this measure of momentum, will get above 70, but will come back and sort of chop around that level, particularly in an extended bull phase, which undeniably we've been in here, certainly May into June. So overall, trend remains strong. I would say just on the short-term time frame, we're stalling out a little bit. You'd love to see, if you're on the bullish side, love to see that reinitiation with the S&P pushing to new highs again. Now, we are seeing new highs in certain areas of the market. I will get to that here briefly, but I want to zoom out a moment and just look at the weekly chart of the QQQ. I wrote some articles over the last week about the Nasdaq and some of those leading names, particularly when we saw those bearish candle patterns that we highlighted on Thursday and Friday's show. Just want to point out that on the weekly chart, remember, depending on your time frame, a lot of times, if you're a longer-term investor, looking at a weekly chart can just help to sort of put things into perspective, right? We tend to get drawn in so much to the moment-to-moment movements, what I call the flickering ticks of the market. And while those are interesting, and while it's fascinating to think about the short-term supply and demand, and if you're, actually pulling the trigger and executing a trade, I don't think it's a bad thing to look at some of the short-term dynamics and just think about what you're actually trying to execute around to see if there's maybe an opportunity to, on the tactical time frame, maybe optimize that a little bit. But really, we should be thinking more about the long-term trends, what I call the primary trend, the overall structure of the market. When you look at the weekly chart of the QQQ, you can see a simple trend line drawn from the end of 2022. This is coming off of the October 22 low, and with the Qs, right? I mean, in December, really right around those same lows. So I remember at this point, it was not a clear, obvious pattern that we were just going to rip upwards from here. I mean, we were testing the lows. So, the Qs go much lower at that point in January. And all of a sudden, this feels just like a continuation of the weak market we observed in the entirety of 2022. But 2023 started in very much a position of strength. And if you connect that January low with the low that we experienced in October, you find out that lines up pretty well with the low that we just experienced in April. So that blue line, as a longer-term investor, I would just keep it simple. As long as we remain above that thick blue trend line, things are not that bad. And that gives us plenty of room to pull back a little bit. I mean, as of, this week, you go from 480 down to 440. That's about a 10%, maybe less, 8% drop in the Qs, and that's still very much within a clearly defined primary uptrend. So there is room for pullbacks that could be quite healthy, even if you're bullish. Pullbacks actually happen quite often, and this chart shows you that those pullback phases have often led to further strength. Get concerned when a trend line like this does not hold, because that might tell you something's different, that it's not just a brief tactical pullback, but something more significant, something that we want to pay a little bit more attention to. I do want to also point out, in terms of breadth conditions, the McClellan oscillator did push back above 0, and that was after yesterday's session. We actually run all of our breadth data a little after the close, once we can lock in the official closing prices of stocks and ETFs, make sure we're working with the right data. But the McClellan oscillator did, as of yesterday's close, push above 0. We'll see what happens today when we update with the current data, but I would guess it probably stays positive as well. And that's kind of noteworthy, because the McClellan oscillator has been below 0 since late May. And so we've had a market moving higher on weaker momentum, right? And that is what a narrow-led market really means, because less stocks are actually doing the lion's share of the gains. But if that McClellan oscillator gets back above 0, that would actually be a much more encouraging structure, because it would tell you that more and more stocks are participating. Now, the problem today is, 8 out of the 11 sectors are actually down, so this might be a blip. We'll have to see as we review the data tonight into tomorrow what sort of things happen. Great reason to monitor this chart list, by the way, called the Mindful Investor Live Chart List. You are free to access it. If you're a Stockcharts member, you can actually copy this chart list to your own login and customize it and draw cool lines and put annotations. But if you're not a Stockcharts member, you can access this list of charts. Go to stockcharts.com, and you want to go to the articles tab, which is where we store all of our articles. Here where it says all stock charts blogs, you want to go to mine, which is called the Mindful Investor. And you'll see this link right here, this gray live chart list button. Click on that, save that hyperlink, and you can get to my updated versions of the of these major market averages and indicators that I follow. Let's continue on here. I want to look at the chart of gold really quick, if we could, and maybe Bitcoin as well. Gold, has been quite a bit of a choppy stretch here for gold. I mean, overall, I would say that the trend over the last 3 months has been decidedly sideways, right? We're seeing some weakness here kicking off the week, but overall, if you look at where we're at right now, gold, the GLD, that is around 214.50. You can see that we were at that exact same level, beginning of April, so almost 3 months ago. We're all at the exact same level. Now, between those 2 points, we've actually had quite a bit of volatility. We've gone up to almost just above 225. We've gone down to around 212 or so, but we've all sort of remained within that range. So I would say gold is in a basing pattern. It's in a sideways or a consolidation pattern. I think of market trends in 3 phases: an uptrend, which I call an accumulation phase, which means overall the trend is higher because buyers are outweighing sellers, or buying power is outweighing selling pressure. You have distribution phases where the trend is overall going down because sellers are outweighing buyers. Then you have these sideways periods, which I would say are a consolidation phase or a sideways phase. And that's the third one, and that's where we're in now. So how do you play this sort of thing? Well, 2 options, right? If you're more of a swing trader, bet on those swings, right? And sort of use good risk management, but, look for that mean reversion and us remaining within that range. As a trend follower, it's more of a medium term or longer term investor, you look for a breakout of the range. So I would say GLD above 225 starts to look pretty constructive. GLD below 210, we'll call it, starts to look pretty weak. And for now, we're just sort of wait and see as we remain between those 2 extremes. Bitcoin, as we talked about on yesterday's show, really has been, coming off here. And I was asked by a media outlet earlier today about the relationship between Bitcoin and the Nasdaq. And, overall, there have been times when Bitcoin and the Nasdaq have actually moved very, very closely together. They've had a very high correlation. As a matter of fact, coming off of that April low, they both were actually rallying pretty good. So late May, the correlation between Bitcoin and the Nasdaq was, and the QQQ was quite high. Right now, actually, the correlation is negative if you look at a 20-day rolling correlation. And that's because the Nasdaq has held up quite well, while Bitcoin has been down for most of the month of June. That relationship is not a very stable relationship. If you look back over the last couple of years, there are times when Bitcoin and the Nasdaq move together, and then there are times when they very much do not. And this is one of those times where they're very much not moving together. Having said that, We have sort of a perfect storm here, what we call a confluence of support, with Bitcoin reaching 60K, which is a big round number, which often has meaning for things like Bitcoin. That lines up with the previous support we experienced in April and May. That also lines up with the 38.2% Fibonacci support level if you take the January low and the March high. So you have a number of different things all sort of hovering around that 60,000 level. So the bounce that we've experienced as the RSI was oversold as we test support, certainly to me seems like a high percentage play that we get a bounce off of that level. And I think that's what we're observing now. The question is going to be what happens after that initial bounce. And I would say as long as that 60K range holds, we're in good shape. If we break below 58,000 and get below the 200-day moving average, which we've been above since October of last year, we break below the 200-day, I think that immediately makes me think down 50 to 52K. That would be the next big round number. That would be the 61.8% retracement. That would be the swing low from February. So it's sort of an if-then statement. If we break below 58K, I think we're getting down another, what we'll call it 6,000 to 8,000 for Bitcoin. Also monitor the momentum, of course, and see if that remains in a bearish range, which is where we're seeing it right about now. I do want to show this chart here. This is the not the year-to-date returns, actually starting at the April market low. The market's bottomed out on April 19th, and if you start the clock there, you can see that the S&P 500 has logged about a positive 10.4% run. Decent gain off of that April swing low. Now, the equal-weighted S&P, the RSP, that's an equal-weighted S&P ETF, has only gained 3.4%. So the Nasdaq composite the Nasdaq 100, the Qs are up 15.8%. So just by owning the Nasdaq instead of the S&P off of the April low, you've outperformed the S&P by over 5%. If you own the biggest growth names, the MAGs, M-A-G-S, you're up about 23%. So the difference between the equal-weighted S&P at 3.4% and the Magnificent Seven stocks essentially at positive 23%, there is your performance gap from the mega cap growth trade to the everything else trade. That is why the benchmarks are where they are. The S&P is much higher because these biggest names have the biggest weights. The Nasdaq is above the S&P because the Nasdaq has much more of a weight in these names. And so if you own anything other than the Magnificent Seven, your returns are looking a lot closer to the RSP than it is the MAGs. And we'll continue to monitor when that relationship changes. But overall, even with the choppiness we've experienced in the last week, it's still the biggest growth names versus everything else. Now, when we think biggest growth names, I'm thinking of something like NVIDIA. Today bouncing higher, 6.8% to the upside. It's tough looking at this chart because, this doesn't look like a big move. These are huge moves, by the way, right? I mean, just looking at the candle chart, we have this tool called the Inspect tool. And if you just look at the high there and drag it down, that little drop is a 16% drop just from the high from 3 sessions ago to where we finished the day yesterday on Monday's trading. Currently, we're about 10.5% off of those highs. So while these look like just little brief moves that aren't that big of a deal, because of the volatility, because of the exceptional exponential rise that we've experienced in stocks like NVIDIA, little 3-day moves are huge percentage swings, where on a normal chart, they would not be that significant. The charts of things like NVIDIA feel and look a lot more like cryptocurrencies than they do actually traded stocks. And I think for me, that speaks to the excessive euphoria that we see around the AI trade to this day. Now, nice bounce higher, we'll see. I think at this point, that low is pretty key. If we can hold 118 on any sort of drop through the course of this week, this could be just a meaningful higher low, and maybe we ride this to the next side. It's worth noting, by the way, that yesterday's close, which for now was the bottom for this pullback, is lining up beautifully with the lows that we experienced in that first week in June. So keep an eye on that 117 to 118 level. It appears to be pretty important here. Speaking of happiness, cruise lines are looking really good. You have Carnival, Royal Caribbean, others having a really nice up day. CCL was up over 8%, almost 9% today. Closed the day around $18, and you can see that that is testing the March swing high. Now, what's great is after mid-April, we sort of retested that low, and now we have a gray pattern of higher highs and higher lows, getting back above moving average support and finding support there, and now the moving averages are sloping higher. So I would say, charts like this did not look particularly strong not too long ago. Royal Caribbean has been much more of a consistent gainer, but Carnival was below the moving averages, making a new swing low. Mid-April looked pretty questionable. Now we've seen some stabilization. Now we've seen a resumption of the uptrend. I would argue that's like an accumulation accumulation phase. I think that's a strong trend getting stronger. I'm very keen on following the potential resistance around $19 a share. There's your high from July of last year and December of last year. Some stocks breaking down that I just want to tell you about. Enphase Energy continuing to not impress. We had the highs around 140 here in December of last year. In February of this year, we retested that in June. You can see over the last couple weeks, we have traded back off resistance. We have gapped below moving averages and continued to accelerate to the downside. We're right around $100 a share, which has served as support and often does. So I could be a potential bounce here. Look to see as we approach that oversold level as we test a big round number. But overall, the trend for sure is appearing to be lower. I think this is PNR. That's not it. PMR. What did I write down? That's not it. I'm going to try one more. Pentair. That's it. I was going to say Pioneer now. Pentair, this is an industrial name in the industrial machinery group. I did want to highlight this one. This is another one I think that just illustrates beautifully a rotation that I described those phases, right? An accumulation phase, a consolidation phase, and then a distribution phase. Now, how can you tell that we rotate from an accumulation phase to a consolidation phase? Well, we stop going up, number one. And the way you can define that is because the highs start to hold. We don't make higher highs. We try to make a new high and we fail. You then test a support level. We set a new support level, and then we test it a number of times. You can draw a rectangle around the price action. I'll show you kind of why that's pretty helpful, because it just defines this range really, really well, right? So here we can see the resistance around 85, the support around 77 and change. Now we can see a distribution phase because we're no longer within that basing pattern. Distribution phase is making lower lows, which we are now doing, and lower highs, which we've now done. We're now below a downward sloping 50-day moving average. The last time we tested the 200-day moving average was here in October, where we briefly traded below before bouncing back above in what you'd call an island reversal pattern. Keep an eye as we near the 200-day moving average. Often an important level that even the most, not technically savvy investors still always seem to know where the 200-day moving average is. Folks, that's our final bar here for today, Tuesday, June 25th. Thanks so much for all of your supportive comments, your thoughtful feedback, and your support of Stockcharts TV. We'll keep coming with a lot of great content. We have had some questions about guest interviews. We're working on ways to evolve this channel, incorporate guest interviews as we've enjoyed doing for so long. We have some really good guests we're starting to line up for some thoughtful discussions that we'll look forward to sharing with you. But in the meantime, I'm Dave Keller here with Stockcharts.com. Be well, stay safe, have a great night.